Welcome back everyone, I hope you're having a great day. In this video, we're going to take a look at my $182,000 dividend stock portfolio. This is the January 2023 portfolio update. I'm going to share with you everything that happened with the portfolio over the past month, discuss my dividend income, take a look at all the current portfolio holdings, and go over the future plans I have for my portfolio going forward. But before we jump into the update, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and on the channel we talk about everything stock and dividend related, and of course we track the progress of my personal portfolio that has now grown to $182,000. So of course this video is my latest portfolio update, so let's get right into it. We can see that during the latest market trading session, my portfolio had a slight decline in value of $867 or 0.5% in the red. But if we take a longer term view on the portfolio and zoom out over my entire trading history, we can see my unrealized gains have now surpassed $34,000 or I'm up 23.4%. So that means if I were to sell all my underlying positions today, I would lock in $34,000 of gains at this current point in time. But as I plan to continue to have all my stocks in the portfolio over the long term, this amount continues to fluctuate. As the stock market declines, my unrealized gains decline as well. When we go through a good month like we saw in January of 2023, this number continues to grow as well. So I don't really focus on the unrealized gains amount because that does fluctuate over time. I focus on the passive dividend income this portfolio continues to produce month in and month out. And if we now jump over to my Simply Safe dividend portfolio, we can see my $182,000 portfolio provides me with $3,614 in annual passive dividend income. So that means if I were to not go into work and just let my dividends continue to flow into my portfolio, I would earn $3,600 or $300 per month in completely passive income. That means my current yield on my portfolio is at 1.98%, but because I buy dividend growth companies, my yield on cost has now grown to around 2.5% overall across the entire portfolio, and because I'm invested in all equities and a lot of the largest companies in the S&P 500, my beta is in line with the overall market volatility at 0.95. So right away, when a lot of investors see my portfolio, they criticize me for having such a low current dividend yield at sub 2%. But my focus of this portfolio is long-term capital growth and dividend growth. I'm not looking for high yield companies that pay out a high dividend today. I'm looking for companies who have sustainable dividend growth histories and will be able to continue to grow that dividend for many years going forward. So I'm primarily focused on strong companies who are able to grow capitally, like their share price will appreciate over time, as well provide a growing dividend to me as an investor, so my cash flow into the portfolio will continue to compound at a rate faster than inflation. So if we take a look right now at my dividend growth, in the latest year, my portfolio grew their dividends at 8.5%. My 5-year dividend CAGR across all my underlying holdings is at 9.6%, and during the past year, the companies I own have been growing their dividends for 10% annually, which is considered fast. So overall, I'm buying companies that are going to allow me to continue to compound my passive income year in and year out, and I don't see any signs of slowing down in this dividend growth from my underlying holdings anytime soon. And of course, with my portfolio, what I'm focused on is providing safe and consistent cash flow every single quarter. I'm not in here to buy risky companies. I have no need for that. Yes, the companies who may have higher risk may potentially provide higher rewards, but that's not my goal for me. It may be for you, but that's not how I view my personal investing journey. So I like to focus on safe dividend companies who provide consistent and growing cash flow every single year. So if we take a look at the dividend safety, 87% of my income is considered safe, while 13% is considered borderline. And if we take a look at that breakdown, Bank of America makes up 5.5% of my income, and JP Morgan Chase at 7.5%. So combined, the two banks make up 13% of my annual dividend income, and those are the only two companies in my portfolio that are considered borderline safe. But of course, as I evaluate the balance sheet and the income statement and the cash flows for both of these companies, I'm not concerned about their dividend safety whatsoever. I think the companies are well capitalized. I think they've done a great job with loan loss provisions. I do not see a dividend cut coming from them anytime soon, and I do believe they'll continue to grow their dividend for many years going forward. And as well, both of these companies do a ton of share buybacks, so they return a ton of capital to me as an investor in many different ways. So I'm not concerned with this 13% borderline safe, and like we can see with the remaining 87% of my dividend income is considered likely safe as well, so no risk or no expectation of a dividend cut coming from any of these companies anytime soon. And we can see a majority of my holdings are considered very safe with a dividend safety score above 85. So overall, again, very safe, consistent, and growing income coming into this portfolio quarter in and quarter out, and I don't see that trend stopping anytime soon. Next, we're going to take a look at my portfolio tracking spreadsheet that lists all the underlying information for each of my stock holdings, and we're going to take a look at my dividend passive income that I made in January of 2023. So this is a very simple Google Sheets that I created that lists each of my underlying stock positions and my current financial information regarding each holding. So this is a way that you can view my portfolio at any given time. It's linked down in my description. It's completely free to look at. I do not ask for your email. I don't charge anything. You can view my portfolio at any time for completely free. And as I make trades in the portfolio, I update this right away. So even if I haven't made an update video for my portfolio, when you click on the link, you are getting the most up-to-date information on my holdings at any given point in time for completely free. So we can see right away my portfolio value agrees to what I first showed at $182,299. But if we jump over to the second tab that is listing all the dividend income, we can see all my holdings, the ticker, how many shares of each I own, the current market price, how much they pay per year per share in annual dividends, and of course when they pay out that dividend. So for the month of January of 2023, I received one single lonely dividend payment from JP Morgan Chase of $68. That is it. Because companies pay out their dividend at different points in time, it just so happens that only one of my companies pays out in the month of January, which is JPM, for $68 in complete passive income. But of course, the timing of your dividends should not matter. Even if you were living off your dividends and you're in that retirement stage, you can just accumulate the dividends each and every month, the higher paying months and the lower paying months, and of course, continue to spend on your budget. But if we take a look, $68 in the month of January, but in February, I'm going to project it to get $227. And then of course, in the months of March, June, September, December, those payouts of 3, 6, 9, 12, that's where a majority of my companies pay out their dividends, and I receive $606 in each of those respective months. So overall, I receive over $900 in quarterly annual dividend income. So every single quarter, I receive $902. And of course, if you take this number and multiply it by 4, you get my yearly annual passive income of $3,608. So of course, this isn't dramatic. I of course could make this number be up significantly by investing in dividend companies who have a yield of 4, 5, 6%, but I think that would hurt my total returns going forward over the next 10, 20 years. So I'm going to continue with my current investing strategy, buy these strong compounders and allow them to grow over time. And now if we jump over to the first tab, this has all my underlying companies, and we can take a look at my portfolio sector breakdown. So we can see tech, of course, is my largest sector at 40.2% of the portfolio, followed by consumer staples at 21.6% and financials at 12.3%. So I am top heavy into tech, but I am comfortable with it just because of the positions that I own in Apple and Microsoft that are considered overweighted for many people's point of view of a portfolio. I personally do not think I'm overweight in those companies. I think they're very strong and will continue to grow going forward. So I'm not really worried about having 40% of my underlying portfolio within the tech sector. Then consumer staples, I think this is one of the best sectors to invest in. Strong, stable, boring businesses that produce cash flow over time. Financials, of course, you saw Bank of America and JP Morgan Chase as my two major financial holdings, and the remaining sectors make up around 5 to 7% respectively across the other industries in the market. And if we take a look at all my holdings, we're going to do a quick overview one by one as we go through the list. In the month of January 2023, I did not make any buys or sells within the portfolio. The month was doing well, the market was going up, and I was going to just wait and be patient to let the market ride up a little bit more before I sell out of some companies. I do want to trim my portfolio down 2 or 3 more holdings just to bring it and make it a little more concentrated into the best performers, but I did not do that in the month of January. If you remember back from December of 2022, I did sell out of 3 companies in the last month of that year. I sold out of Kimberly-Clark, Lowe's, and Southern Company. So I did reduce 3 companies just 2 months ago, but over the past 30 days, no sells or buys within the portfolio. So nothing has changed, but let's still do a quick overview of all my current positions. So if we start off at the top, we have Apple and Microsoft, the 2 largest positions in the portfolio. They fluctuate between 1 and 2 at all times, and they've pretty much held that market leadership position in my portfolio ever since I started investing over 5 years ago. Both companies have a current market value above $21,000. Apple is slightly above Microsoft at this current value at $21,630 compared to Microsoft's $21,184 in current market value. These companies have always been number 1 and number 2. Some investors say I'm overweight in these positions, but I don't believe in that. I don't think you can be overweight in companies you believe in. They both have very strong financials, will continue to buy back a ton of shares and produce a lot of cash flow every single year going forward. Next, we have Visa coming in with a market value of just over $11,000. This company has the market leadership position with around 50% of the market share in the credit card industry. I think the brand is very strong. Their underlying moat, I think, is incredible, and I don't see many companies coming in and actually disrupting Visa from their number one market leadership position. And with their incredibly high margins, this is just an overall fantastic business with some great financial statements. Next, the last two companies within the tech sector, I have Broadcom and Qualcomm. Two semiconductor companies. I think as a whole, semiconductor companies are going to perform very well going forward over the next decade. The demand for chips is only growing. Everything we use is built with chips now going forward with all the tech we rely on every single day. So I wanted exposure to that subsector of the tech industry. So I'm with Broadcom and Qualcomm, two companies who pay out a growing dividend every single year, strong financials, and very strong brands within their respective industry. So overall, those five companies make up around 40% of the total portfolio value I have within the tech sector. Next, we're going to take a look at my financial companies, which are comprised of JP Morgan Chase, Bank of America, and BlackRock. I went with the two largest traditional banks and the world's largest investment firm. So overall, I just went with the big boys. These companies make a ton of money every single year. They have the ability to grow margins and increase cash flow over time. And they also, I do believe, will continue to buy back a lot of their shares, returning capital to me in that way, and also pay out a growing dividend. So overall, I think all three of these companies are going to provide solid returns going forward. Many people are shying away from the financial sector, but I'm not too concerned with it. I like my financial holdings and I'm comfortable with it being around 12% of the entire portfolio's value. Next, we have Verizon. They are the only communication company that I own. I have 100 shares with a market value of $4,000. So of course, this company does have a massive dividend yield above 6%. They do produce a ton of dividend income into my portfolio. It is a minor holding of only 4% of value. I'm not expecting anything dramatic from this holding. I just like the massive dividend. The dividend is ranked as very safe from Simply Safe Dividends as well. So I think the cash flow will continue to grow at a minimal rate over time. So I pretty much just have Verizon in the portfolio for that massive yield as a dividend investor. Next, we're going to take a look at my healthcare companies. I have AbbVie and Johnson & Johnson. These companies have both performed well. I bought AbbVie maybe 2-3 years ago when it was at a very low point, and I'm up over 85% overall in this position. When I bought AbbVie, had a yield above 5.5%, and even after the major increase in price, the company still has a yield above 4%. And then we all know Johnson & Johnson, a dividend investor's top company, a dividend king, great financials, solid dividend, continue to grow it year in and year out, and overall, very boring and stable business I love having in my portfolio. Next, we have the consumer companies, which are Home Depot, Costco, Pepsi, Procter & Gamble. So of course, I do have these combined as consumer staples. Home Depot is my only consumer discretionary company just because the items you sell at Home Depot, you can argue are somewhat consumer staples, but also I just believe because of the nature of home renovations, people usually do that when they have excess savings and cash flow coming in. It's more of a discretionary purchase to upgrade your home items. So I have Home Depot as my only consumer discretionary company. Again, market leader. I personally enjoy shopping at Home Depot. I bought a lot of goods there. So I think if I shop there, many other people will. If you look at the company's financials, they continue to grow sales each and every year. And even after the massive boost they saw in pandemic sales because consumers were forced to stay home, the company is still able to generate growing revenue even with those massive comparables. So overall, a very strong business in Home Depot. Then Costco, Pepsi, and Procter & Gamble. Three companies I consider to be very strong consumer staples. Costco is actually the third largest position in the portfolio with a value of $19,000. And overall, I think this business, they may operate one of the best businesses in the world. I just love the business so much. Their financials are impeccable. I think they're slightly overvalued at this current price point, so I'm not going to add to my position in Costco, but I will continue to hold over time. Then Pepsi and Procter & Gamble. Not much I can say about those. Two, pretty much I like to call them umbrella companies. They all operate a main brand, but own dozens of other market leadership products within the respective industry as well. Next, if we continue on into my utility/energy sector, I have Duke and NextEra. Duke is more of a traditional regulated utility. Then I have NextEra, which of course also operates a regulated utility business, but they also have a strong renewable business as well, which is why I own them, because I do think green energy is the future. I don't think investing in those young green energy companies right now who are losing money each and every quarter just to kind of establish themselves is the right play into green energy. But I think going with a company like NextEra, who has a combined traditional but also renewable energy sector that also provides a growing dividend to their investors. They're profitable, have strong contracts in place, might be the best way to enter into that industry right now. So that's why I chose NextEra. And finally, the last company that I own is Canadian National Railway, ticker CNI. I think, again, similar to MasterCard and Visa, railways have an oligopoly with Canadian Pacific, CNI, and also Union Pacific. So I chose the company I believe had the best value at the point of purchase. I bought this company over 2 years ago, and at that point in time, I thought they had the best value compared to their peers. So overall, that's why I made the decision, but you can't really go wrong with any of those 3 railroads. So those are all the companies I have in my portfolio. No dramatic changes whatsoever as of late. January 2023, like I mentioned, I did not make any buys or sells, and overall, those are the current portfolio holdings. So that's pretty much everything I have for you in the January 2023 portfolio update. Let me know in the comments what you think of my portfolio, if you agree with my holdings, if there's anything that I should add or sell. Give me your thoughts. I love to read them, and I want to thank you for watching the video all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next video.